Is it time to buy Vodafone Group? They are currently offering a yield of 10.4% towards the 52-week low, and spoiler alert, Wall Street believe there to be some significant upside, which we will touch upon in today's episode. Now we're going to run through the historical performance as always, looking at their top line, bottom line growth, net income, revenue in their financial statements, as well as their health of the company through their total cash and total debt analysis. We'll also touch upon some of their competitors in the wireless telecom service industry, and we will also see what are the institutions doing. And don't forget, we will discuss their dividend safety as well as some important financial metrics for this company. And finally, we will get them through the stock valuation model, getting to our intrinsic value and our acceptable buy price given that all-important investor margin of safety. Now, Vodafone, for those that don't know, are in the telecoms industry, as we can see towards the 52-week low with a very impressive 10.4% yield. Now, one thing to note, investors who have been holding this company over the last 10 years would be down around 62%. Now, what we want to find out in today's episode is not only is there upside to the current trading price, which has been hammered for a significant amount of time, but can we see our yield on cost grow into the double digits in high figures, 15, 20, 25%. So let's take a look at the income statement. How has the company performed over the last few years on the top line and bottom line? Typically, 3 to 7% growth is what we are after, and we can see 49 billion reported in March 2019. March 23, their latest annual report, roughly in line with that of 5 years ago. So straight away, we can see there hasn't been much real growth over the last 5 years. And adjusted for inflation, you could say in real terms, it hasn't increased. On a more granular level, we do see a very small increase from March 19 to 2021, before it dropping in 22 and 23. And we'll touch upon the last 5 to 10 years in percentage form as well. Bottom line, well, a net loss in 2019 of 9 billion, and we can see they have turned it around with a massive 12.8 billion net income in March 2023. So what is positive to see, although the top line has found it difficult to increase rapidly, or even in fact with our 3 to 7% target, we can see the bottom line having consistently increased over the last 5 years, which is a positive sign, especially if we see that top line starting to increase as well. Now, cash versus total debt, always a quick look at the health of a company, and this does include their short-term investments. March 2019, 28.5 billion on the balance sheet, latest quarterly report. Now, they do hold less cash, but they still hold around 20 billion in their latest quarterly results. Now, in terms of how that 20 billion compares to their total debt numerically and directionally, well, they did hold around 64.5 billion, or 64.2 in fact, in March 2019. Latest quarterly report, that has risen by around 10 billion. So whilst we see their top line cash drop, we do see their total debt increase. And we'll touch upon this when we look at their net debt to EBITDA metric as well. So companies in the wireless telecom service industry, we have Rogers Communications, we have TIM SA, SK Telecom, as well as a few others. Now, year-to-date performance, including those dividends reinvested, we do see Vodafone in the middle of its peers with a loss of around 3.3%. Now, let's take a look at 5 years, and as always, when you have the data available, do always try and take a look at more than a few years, 5 to 10 years where possible. So over the last 5 years, we can see Vodafone, in fact, the worst performer of its peers, down 34%. Not great, but remember, we never look at past performance as an indicator for the future. It is just one layer of our review process. Now, institutional ownership around 7.82%, and we can see around 830 million worth of shares sold by institutions over the last 12 months, with around 608 million bought. So over the last 12 months, institutions have sold more than they have bought. We can clearly see that in quarter 3, but if we go back to quarter 2, we in fact see the opposite, and there has been a mixed trend on quarter to quarter, with some quarters institutions buying more, with some quarters buying less. But remember, we're not copying what the institution's doing on this channel, we are just using it as one level of review, so always do your own due diligence. Now, dividend safety score 30, making it unsafe. And as we can see here, a market cap of 25.7 billion, making it a large cap company. So let's take a look and try and understand whether or not we agree with this safety. And let's just take a look at their metrics. So for those that do see a recession inbound, well, they did in fact increase the dividend during the 07-09 recession. They also had 4.4% recession sales, which was above the average growth. Remember, average growth for companies in the S&P 500 was negative, and we can see their recession return fairly similar to that of the S&P's negative 55, so something to digest on there for viewers who believe a recession is inbound. Now, they haven't had the greatest dividend growth history. The last year was minimal growth, in fact, no growth. Last 5 years, negative 10%, so they did have a dividend cut. And the last 20 years, 5%, which is okay. It is above that 4% inflation target I do advocate on the channel. Now, as we can see here, a graph just showing the historical performance of their dividend. They did have that dividend cut not only once in 2013, but also in 2018. And we can see the last few years it has been relatively flat, bearing in mind it does now yield over 10%. Now, when we take a look at dividend yield theory, as always, it does indicate undervaluation when essentially the yield is above that 5-year average. So we have our first sign of undervaluation, but remember, we're not looking at any of these models in isolation and drawing our conclusions towards the end of the episode. Again, forward PE roughly in line with the 5-year average, so based on the forward PE, you could argue reasonable valuation. And we can see the sector PE slightly higher at 18.4. Now, just because this is right there at the 52-week low, do not make any investment decisions based on that. 52-week low is not a signal for undervaluation or a buy signal. As always, remember the earnings is susceptible to manipulation by management through accounting. We do really want to focus on that free cash flow payout where possible, and below 60% is personally ideal. We do move it up to around 70% for telecoms. And what we can see is for the large part of the last 10 years, it has been around that 70% or lower. In fact, the last few years, it has been below even 60%, which is what I quite like to see, as it gives me faith that companies can in fact offer double-digit increases. So that is positive to see. So far, even based on 2024, where it may be expected to go above 70%, so far from what we can see, in my opinion, that dividend does look safe. Now, free cash flow, negative 2 cents in 2014. Positive to see 32 cents in 2023, so it has been increasing over the last 10 years, but we can see for the last 4 years it has remained relatively stable. Now, when we look at sales growth, remember 3 to 7% increase year on year. Now, you could argue the cyclicality of the telecoms business, which is why in the industry, why we're seeing these positive followed by negative. But realistically, you do ideally want to see at least companies keeping up with inflation, if not more. So when we look numerically at total sales, we see 38 billion in 2014 to around 46 billion in 2023. Now, yes, that is growth, but if you do take a look from, in fact, 2015, it has remained relatively stable. So you could argue this company isn't keeping up with inflation in real terms, but do let me know your thoughts on the telecoms industry as a whole in the comments below. Now, shares outstanding, we love it as investors when companies do share buybacks. It has gone from 26.7 billion in 2014 to 27.8. So they have in fact done share issuances, which does dilute your position as a shareholder. But at the same time, we do in fact see some very small share buybacks. Over the last 10 years, then we can say there has been very minimal movement, around 1 billion increase, 1.1 billion increase. Now, ROIC, remember, above 10% is what we like to see on the channel. It does mean management are able to effectively allocate their capital. Above 9%, as we see here for telecoms. Now, this is a worry for me. We're not seeing at the levels we like to see. The only real time where we accept lower, or in fact between 3 to 5%, is when we analyze REITs. So it is a bit of a worry that right now we are seeing 3 to 4% over the last few years for this company. So do bear that in mind. With Vodafone, not everything is very positive, and we should never jump on a company solely based off the dividend yield. Operating margin, free cash flow margin. Well, operating margin, they are struggling to keep up with that 14% that we like to see. Remember, the higher the operating margin, the higher, in essence, that bottom line net income should be, which then should translate into higher dividend growth. Free cash flow margin, above 7%. They have managed from 2017 to be above that, with 2020 to 2023 looking very nice in the low 20s. And net debt to earnings before interest, tax, depreciation, amortization. Remember, this does directly correlate to that dividend safety. Below 3.5, so the number of years it would take the company to pay off all of their debt net of cash on hand. And we can see 2023 has had some improvement. It's fallen, as we can see, from 2020. Although do note in 2024, it is expected to go up slightly higher above that minimum level, or maximum level, in fact. So again, a few things just to consider. But overall, we do see, based on the information provided, the dividend safety score of 30, making it unsafe. So what about the valuation? Does the valuation look like it is an undervalued company? So as always, if you do enjoy the content so far and value is being provided, hit that like button. It really helps the channel grow and for this video to be put out to many people, many investors out there. And if you do enjoy the content, subscribe and hit the bell to be continually notified of these episodes. And finally, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. So let's jump into our first model, Graham's valuation, with the stock ticker, earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remembering that the higher the yield goes, the lower our intrinsic value goes. So based on Graham's valuation, we have a price of $8.57. Now taking a look, we see that is slightly lower than the 52-week low, showing signs based on Graham's model of overvaluation. It is important to note though that we aren't looking at any of these models in isolation. The second model, multiples valuation model, we have a companies that we did analyze on the 5-year comparison, Roger Communications and Tim. We have the stock price, earnings per share, getting a PE average, multiplying that by the average PE, and the earnings per share of Vodafone to get a stock price of $8.66. As we can see, slightly lower than that 52-week low, showing some signs of overvaluation in the current market. We then move on to the dividend discount model where we have the yearly dividends. Now we have just inputted the current dividend, which is around 97 cents. And we can see based on the Simply Safe dividends look that we had, it is a negative 10% over the last 5 years. Now forward looking, I have gone for around 0% growth. We have seen, if we do want to take a very quick look at the dividend growth over the last 4 years, it has remained relatively stable. So in my opinion, I have gone for 0%. Again, if you do argue that is conservative, as always, you can grab a copy of the model and play around with the figures or figures for companies of your own. This gives us a DDM price of $12.14. So when we take a look, that is right there at the 52-week low, showing signs of undervaluation in the current market based on the DDM model. We then move on to the final model, the DCF discounted cash flow model, where we have our free cash flows year on year. Now, average growth rate around 21%. We have gone for a more optimistic, well, in fact, pessimistic growth rate around negative 10%. We do see the last year around negative 13%. Analysts estimating a more positive outlook, but we have tried to be a lot more conservative. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value, divide by shares outstanding to get a DCF price of $15. Now that is higher than the 52-week high and nearly double the current trading price, showing signs again of undervaluation in the market. So remember, the intrinsic value is just the average of the 4 models, and if you are enjoying the content, hit that like button. It really helps the channel, and hit that subscribe and bell if you want to be continually notified of these episodes. So current price at $9.52. Remember, margin of safety, we start with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data, but it is subjective to the investor themselves. So 10% margin of safety, it would be a buy up to 10.72. At 15%, it would be a buy up to 10.12. And at 20%, it would effectively be a buy at the current trading price. So based on the estimates and judgments we've run through in today's episode, Vodafone would be a buy if you were looking for a 20% margin of safety. For those looking at a 25% margin of safety, it would be a buy at 8.93. And those looking at 30%, it would be a buy at 8.34. And we can take a look, that is lower than the 52-week low, but it does come down to the individual investor's style, risk and preference. So Wall Street, well, they believe there to be some significant upside to the current trading price above the intrinsic value that we have got here at $11.91. So they do believe this to be a strong buy. Remember, as always with these videos, to do your own due diligence. Never copy what the institutions do. Never copy, in fact, what Wall Street say, and always do your own analysis. Let me know your thoughts in the comments below. I am intrigued to hear whether or not you believe this to be a buy, better than AT&T and Verizon for those US investors, or just in general if this is one on your radar. Don't forget to hit the like button, subscribe and hit the bell if you want to be continually notified of these episodes. And don't forget, if you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio and acceptable buy price, then click on that pinned comment below. As always, have a great day, catch you on the next episode and take care.